I want to start today's video with a question. Do you believe your Social Security benefits are completely tax-free? If you answered yes, I completely understand why you think that. You paid into Social Security your entire working life with money that was already taxed. It feels like getting your own money back. It feels like it should not be taxed again. But here's the truth. For millions of Americans, up to 85% of their Social Security benefits are subject to federal income tax. And the worst part is that most retirees do not discover this until they file their taxes and get an unexpected bill from the IRS. Today, I'm going to explain exactly how Social Security gets taxed, show you the real dollar impact, and most importantly, walk you through strategies you can use to reduce or even eliminate that tax burden. Let us start with some history so you understand how we got here. Before 1983, Social Security benefits were completely tax-free. No federal income tax on any Social Security payment. That was the original design of the system. But in 1983, Congress was facing a Social Security funding crisis and they needed new revenue. As part of a broader reform package, they made a portion of Social Security benefits taxable for higher income retirees. Then, in 1993, Congress expanded the taxation even further. The thresholds that determine when Social Security becomes taxable were set in 1983 and 1993, and they have barely been updated for inflation since then. This is critically important, because what was considered a higher income retiree in 1983 is now a completely average income retiree thanks to 40 years of inflation. As a result, far more retirees are subject to Social Security taxation today than Congress originally intended. Now, let me explain exactly how the tax works, because it is not as simple as you might expect. The IRS uses a concept called combined income to determine how much of your Social Security is taxable. Combined income is calculated like this. You take your adjusted gross income. Then you add any tax-exempt interest income you have, such as from municipal bonds. Then you add 50% of your Social Security benefit. That total is your combined income. Based on where your combined income falls, none up to 50% or up to 85% of your Social Security benefit becomes subject to federal income tax. Here are the specific thresholds. For single filers, if your combined income is below $25,000, none of your Social Security is taxable. If your combined income is between $25,000 and $34,000, up to 50% of your Social Security is taxable. If your combined income is above $34,000, up to 85% of your Social Security is taxable. For married couples filing jointly, if combined income is below $32,000, zero is taxable. If combined income is between $32,000 and $44,000, up to 50% is taxable. If combined income is above $44,000, up to 85% is taxable. Now let me show you what this actually looks like in real dollars. Let us take the example of a married couple, both age 68, collecting Social Security. Together, they receive $3,000 per month in Social Security, which equals $36,000 per year. In addition, the husband has a pension that pays $22,000 per year. Their adjusted gross income from non-Social Security sources is $22,000. Now to calculate combined income, we take $22,000, add 50% of their Social Security, which is $18,000, and that gives us a combined income of $40,000. $40,000 is above the $32,000 threshold, but close to the $44,000 threshold. So up to 50% of their Social Security is taxable. 50% of $36,000 is $18,000. That $18,000 is added to their taxable income. At a 22% federal tax bracket, they owe $3,960 in federal taxes, just on their Social Security. Nearly $4,000 per year that many retirees do not see coming. Over 20 years of retirement, that is nearly $80,000 in taxes on income they believed would be completely tax-free. Now I want to talk about a common misconception that makes this situation even worse for many retirees. Many people believe that because they contribute to a traditional IRA or a 401k during their working years, they will save on taxes. And during the working years, they are right. Those contributions reduce taxable income today. But in retirement, every dollar you withdraw from a traditional IRA or 401k is counted as ordinary income. And that ordinary income counts toward your combined income calculation. This creates what is sometimes called the Social Security tax torpedo. As you pull money from your retirement accounts, your combined income rises. As your combined income rises, more of your Social Security gets pulled into taxable territory. At certain income levels, you can be in a situation where an extra dollar of retirement account income effectively causes more than a dollar of tax liability because it is triggering taxation on your Social Security. This is one of the sneakiest aspects of retirement tax planning that almost no one talks about until it is too late. Now let us talk about the good news, which is the 2026 tax changes. As I mentioned in my previous video about the 2026 Social Security changes, a new law called the One Big Beautiful Bill added an additional standard deduction for people age 65 and older. The additional deduction is $6,000 for single filers and $12,000 for married couples where both spouses are 65 or older. This additional deduction reduces your adjusted gross income, which in turn reduces your combined income, which in turn reduces how much of your Social Security gets taxed. For many retirees in the middle income range, this deduction could push their combined income below the taxation threshold entirely. For others, it will provide meaningful but partial relief. But again, this deduction expires after the 2027 tax year, so the window to benefit from it is limited. Now let me walk you through the strategies that can permanently reduce your Social Security tax burden, not just for 2026, but for the long term. Strategy 1 is the Roth conversion strategy. This is one of the most powerful tools for managing Social Security taxation. A Roth IRA works differently from a traditional IRA. When you withdraw money from a Roth IRA in retirement, those withdrawals are completely tax-free and they do not count as income in your combined income calculation. If you can convert some or all of your traditional IRA or 401k money into a Roth account before you start claiming Social Security, you reduce the amount of taxable withdrawals you will need to make in retirement. Fewer taxable withdrawals mean lower combined income. Lower combined income means less of your Social Security gets taxed. The best time to do Roth conversions is typically between retirement and when you start claiming Social Security, when your income may be temporarily lower. You pay the conversion taxes now at a lower rate and save significantly on Social Security taxes later. Strategy 2 is careful management of your retirement income sources. Not all retirement income counts the same way for Social Security taxation purposes. Regular pension payments and traditional IRA withdrawals count fully toward your combined income. Roth IRA withdrawals do not count at all. Municipal bond interest counts even though it is tax exempt for regular purposes. Life insurance policy loans do not count. By strategically choosing which accounts you pull income from each year, you may be able to keep your combined income below the taxation thresholds. Strategy 3 is timing your Social Security claim relative to your other income. If you are still working part-time, every dollar of employment income adds to your combined income and potentially pulls more Social Security into taxable territory. In some cases, it makes sense to delay Social Security until you fully stop working so your combined income is lower. This strategy also ties back to the broader discussion of when to claim Social Security. Waiting longer to claim not only increases your monthly benefit, but may also give you time to do Roth conversions at lower tax rates, putting you in a better position when you do start collecting. Strategy 4 is consulting a tax professional who specializes in retirement income planning. I want to be honest with you. Tax planning around Social Security is genuinely complex. The interaction between Social Security income, retirement account withdrawals, investment income, pensions, and tax deductions requires careful calculation specific to your individual situation. A good tax professional or retirement planner can model different scenarios for you and help you find the combination that minimizes your total lifetime tax burden. The cost of that consultation can pay for itself many times over in tax savings. Let me now bring everything together. Social Security benefits are not automatically tax-free. Depending on your combined income, up to 85% of your benefits can be taxed at federal income tax rates. This affects millions of Americans who had no idea it was coming. The thresholds for taxation have not been updated meaningfully since the 1980s and 1990s, which means more retirees are caught by the tax every year. The 2026 additional standard deduction of $6,000 to $12,000 for seniors provides meaningful but temporary relief, and it expires after 2027. The most effective long-term strategies involve Roth conversions before claiming Social Security, careful management of which retirement income sources you use, and strategic timing of your Social Security claim. If you have not yet thought carefully about Social Security taxation in your retirement plan, now is the time. The earlier you plan, the more options you have. Waiting until you are already collecting and already filing taxes leaves you with fewer tools to work with. Please take the time to understand your specific situation. Check your projected combined income for retirement. Explore whether Roth conversions make sense for you. And talk to a qualified tax professional before you make your final Social Security claiming decision. If you found this video valuable, please subscribe and share it with anyone you know who is approaching retirement. This is exactly the kind of information that can save a family tens of thousands of dollars, and most people never hear it from their accountant or their financial advisor. I publish new Social Security strategies every week. My next video is going to cover Social Security survivor benefits and why widows and widowers are often leaving significant money uncollected. Thank you for watching, and I will see you in the next video.